Hello friends, the next topic under the topic cut again start. Hello friends, the next topic is illustrations, which is part of the main topic income from house property. In these illustrations, we will be covering MCQ as well, which will have four options. MCQ plus illustrations will help you to interpret the provisions of the income from house property more clearly. Stop. Now let's start with the illustrations part. First illustration, examine under which head of income the receipt would be assessed. Mr. X let out his property to Mr. A. Mr. A sublets it. How is subletting receipt to be assessed in the hands of Mr. A? So in the first illustration, we have been asked what is the nature of the income of subletting and in which head the same will be taxable. Is it income from house property or not? So let's analyze the solution. Mr. X is the owner who has let out the property to Mr. A. So Mr. A being the owner, the rental income will be taxable as LOP in the hands of Mr. X, whereas Mr. X has also subletted to another person. Now he has an income from subletting. So, for example, Mr. X has rented out the property to Mr. A for 100 and Mr. A has further sublet it to another person, let's say for 20 rupees per month. So, this 20 rupees is an income in the hands of Mr. A. However, Mr. A is not the owner of the property. Owner is Mr. X. Owner of the property is Mr. X. In absence of ownership, the receipt of income will be taxable under the head income from other sources or business or profession. Why business or profession? If at all it's the business of Mr. A, then it will be taxable under PGBP, profit and gains from business or profession. Else it will be taxable under the head income from other sources. So the answer to the question is, how is subletting receipt to be assessed in the hands of Mr. A? The same will be taxable under the head income from other sources or profit or gains from business and profession, as the case may be. Question number 2. Mr. CA has built a house on a leasehold land. He has let out the above property and has considered the rent from such property under the head income from other sources. Now, let's pause for a while over here. Mr. CA has built a house, he has constructed a house on a leasehold land. So, he is not owning the land, however, he is owning the property, he is owning the building on the land. For the purpose of taxability, under the head income from house property, ownership of the land is not mandatory. Ownership of the building is required for the purpose of taxability under the head income from other sources. So, ideally, the correct way is Mr. CA should be taxable on the let out income under the head income from other sources. But however, as per the question, he has taxed under income from other sources. Second part, and deducted expenses on repairs, security charges, insurance and collection charges in all amounting to 50% of the receipts. So on an ad hoc basis, we can say he has taken a deduction of the expenses that he has paid. However, since it is taxable under the head income from house property, he will get a standard deduction as per section 24A. A standard deduction of 30% will be available to Mr. CA. So the correct answer is Mr. CA is the owner of the building. Let out income, rental income will be taxable in his hands under the head income from house property, and he is eligible to get a standard deduction of 30% on the net annual value of the property. Now, second illustration. Mr. A owns a house in Mumbai. During the previous year, three-fourths of the portion of the house was self-occupied. Three-fourths is self-occupied, and one-fourth portion was let out for residential purposes at a rent of 12,000 per month. So, three-fourth portion is SOP and one-fourth portion is LOP, and the rental income is 12,000 per month. The tenant vacated the property on Feb 29, 2020. The property was vacant during March 2020. So the vacancy part will be useful for calculating the expected rent, for calculating the GAV, gross annual value. For the purpose of calculation of gross annual value, this vacancy part of 1 month will be relevant. Moving on, rent for the months of Jan and Feb could not be realized in spite of the owner's efforts. All the conditions prescribed under Rule 4 are satisfied, so the unrealized rent is also there for 2 months. Municipal value of the property is 4 lakhs. Fair rent is 4 lakh 40,000. Standard rent is 4 lakh 80,000. Higher of municipal value and fair rent is 4 lakh 40 and restricted to 4 lakh 80. It is nothing but 4 lakh 40,000 is the expected rent. He paid municipal taxes at 10% of the municipal value. Further, a loan of 30 lakhs was taken by him during the year 2010 for acquiring the property. Interest on loan paid during the previous year was 1,48,000. So we have the interest amount for the current year, but do we have interest amount for pre-construction interest? I mean, there is no information on the acquisition of the property or when the acquisition was completed. So there is no possibility of pre-construction interest therein. Fine. So there is interest amount which is paid during the year, and that will be apportioned based on self-occupied property and let-out property. Compute Mr. A's income from house property for the assessment year 2021. Now let's try to solve the problem as it is you're solving in the examination. This will be useful from the presentation wise. I mean, this type of problem you may have done earlier as well on a similar note, but this time around, why solving this problem is important again, because you need to keep in mind the format, the presentation of the solution in the examination. So as far as possible, I will try to present the answer in a proper solution. Cut. Start. Now the comment section. I won't be able to draw the table as such. However, the table that will be required is the particulars and the amount column. So the particulars will be mentioned on the left hand side, my left hand side and left hand side of the screen, and the amount will be mentioned on the right hand side of the screen. So to start with, computation, computation of income from house property of Mr. A for the assessment year 2021. So this will be the header. Then particulars and amount will be bifurcated. In your notebook, it will be bifurcated column wise. Now the first unit, which will be, let's consider self-occupied property. So in a way, what we are trying to say is the property is divided 3/4 for self-occupied property and 1/4 for the let out property. So unit 1, this is self-occupied property. In examination, you will have to write in full form. Let me put it over here in full form. Unit 1, self-occupied property. Then it will be annual value. Annual value is nothing but nil. This will be in the amount column. This can be termed as annual value, can be termed as net annual value as well. But however, in self-occupied property, there is gross annual value is nil. Municipal taxes are not allowed as deduction. Net annual value is nil. So you can mention it over here that annual value is nil less deduction under section 24B. Working you can mention over here. Working, if you see 30 lakhs is the amount and interest on loan paid is 1,48,000. So 1,48,000 into 3/4 amount, which should be 1,48,000 divided by 4 into 3. So 1,11,000 is the amount of interest available, and the SOP property, the loan was taken after 1st of April 1999 and it was taken for the purpose of acquisition. Accordingly, the entire interest amount, apportioned interest amount, will be available as deduction. So you have income from unit 1, which is nothing but, I should be mentioning it over here, loss from unit 1, which is let me see if I can do it bold over here. Yes, I can do it. So loss from unit 1 is this much. Now moving on to unit 2. I don't want it bold. Unit 2, which is the let out property. In this case, we'll have to calculate the gross annual value and expected rent and actual rent received or receivable. So first is you will have to mention it as stepwise, and this is how you may present in the examination. So from presentation wise, I am writing each and every sentence over here so that it will help you out in examination while presenting your answer. So first is computation of GAV. You can mention it in the short form over here, that is fine. Computation of GAV. Step 1 is computation of expected rent. Expected rent is nothing but higher of municipal value or fair rent, higher of municipal value or fair rent, but restricted to standard rent. Accordingly, you can mention it over here. ER is equal to 4,40,000, and this will have to be apportioned as well. ER apportioned, which is 4,40,000 into 1, or you can just mention divided by 4. So it is 1,10,000 over here. 1,10,000. Now step 2, which is the actual rent. Step 2, computation of actual rent received or receivable. Received or receivable. In this, actual rent is nothing but 12,500 per month. Here it is. And the property was vacant in March 2020, and there was unrealized rent for 2 months as well. So effectively, the rent has been received only for 9 months, but we will have to calculate for the entire month because the vacancy allowance needs to be calculated and compared with expected rent. Rent for 9 months, it's nothing but 12,000 into 9 is equal to 1,08,000. So in this case, there is a possibility that the unrealized rent should be mentioned in the note section separately, or so there is an option available to you. Either you can mention the deduction of unrealized rent over here for 2 months over here, or you can mention it under the note section. Let me mention it over here. Unrealized rent or unrealized rent for 2 months. Unrealized rent for 2 months is not being offered to tax as conditions of rule 4 are satisfied. Then step 3 is gross annual value. How to derive it? So there would be comparison of expected rent and the actual rent. In those cases, if you see the expected rent is 1,10,000, and the actual rent after reduction of unrealized rent is 1,08,000, and we haven't considered the vacancy allowance as well. The vacancy, the month of March, rental income of month of March is not calculative. If it would have been calculated, then 1,08,000 plus 12,000, 1,20,000 would have been the amount. Accordingly, expected rent and actual rent, whichever is lower, would be considered. In this case, accordingly, 1,08,000 will be considered. Explanation for it will be that as per section 23 1 C, clause C, 23 1 is nothing but LOP, let out property income, and clause C is applicable where the actual rent received or receivable is less than the expected rent only because of the vacancy. If this is the scenario, then the actual rent received or receivable will be the gross annual value only because on account of vacancy the actual rent received is less than the expected rent, which is coming out of section 23 1C. So you'll have to mention a note after this computation wherein you can mention the sentences that I have stated right now, in which the provision of section 23 1C can be mentioned, and accordingly how the amount is derived of GAV you can note it down. So as per explanation, as per section 23 1C, the actual rent received will be considered even if it is less than the expected rent. So the GAV is 1,08,000 over here, and obviously the actual rent amount won't be apportioned in this case because they're already considering it for one-fourth portion. They have already apportioned the expected rent part, but the actual rent received or receivable is not to be apportioned. So gross annual value is nothing but 1,08,000 less municipal taxes which are paid. Again, it will be apportioned, I feel. It is 10% of the municipal value. Municipal value is nothing but 4 lakhs. So 40,000 is the amount. 40,000 divided by 4 is nothing but 10,000. Annual value is like 8,000 minus 10,000, which is 98,000. Then less reduction under section 24A, which is 30% of NAV, and always mention it here as NAV, short form. So it is nothing but 98,000 into 30%, 29,400, and less interest under section 24B, which is nothing but you will have to calculate 1,48,000. It should be one fourth. Yes, one fourth. So the amount should be 1,48,000 divided by 4, 47,000. So income from house property is nothing but 98,000 minus 29,400 minus 37,000. So this is the let out value actually. Unit 2, income from unit 2. You can mention it over here. It is 31,600, and income from unit 1 or loss from unit 1 is 1,11,000 and 31,600. Ideally, you will have to mention over here loss under the head income from house property, which is nothing but 79,400. So there is no income as such from the house property for the assessment year 2021. However, there is a loss from the house property. There is a loss under the head income from house property of 79,400. So in this case, we have seen that unit 1 and unit 2 are apportioned, and how expected rent is calculated, how actual rent is calculated when there is vacancy allowance and when there is unrealized rent, and then the apportionment of the gross annual value of the municipal taxes, of the interest amount as well, and accordingly the loss under the head income from house property is calculated. Again, I will repeat that is equal to, and the amount is to be mentioned in a different particulars in a different column. So in a format you will have particulars and amount. Particulars you will mention all the wordings, and in the amount section you will mention all the amount, and if required you can mention the additional notes after the computation. So this concludes the third illustration as well. During the financial year 1920, Mr. A received a sum of 1,80,000, 60,000 per annum by way of arrears for the last 3 years, as the government department enhanced the rate of rent with retrospective effect. Will the sum of 1,80,000 be taxable in the assessment year 2021? Can it be spread over the last 3 years? So arrears of rent received subsequently is taxable in the year of receipt as per Section 25A of the Income Tax Act 1961. Accordingly, to answer the first question, will the sum of 1,80,000 be taxable in the assessment year 2021? The answer is yes, 1,80,000 will be taxable in the year of receipt, and the same was received in the financial year 1920. And it cannot be spread over the last 3 years. The entire amount will be taxable in the year of receipt, and 30% standard deduction under section 24A will be available to the SSC. So the answer to this question is, in short, that section 25A is applicable, and the rent received in the year financial 1920 is taxable in the year of receipt. The entire amount is taxable, and 30% deduction is available. 30% deduction, standard deduction is available. Also, even if Mr. A is not the owner in the year of receipt, It doesn't matter. It will be taxable irrespective whether Mr. A is the owner in the current year or not. Next illustration. Mr. A is the co-owner of a house property. So co-owner, section 26, along with his brother holding equal share. Your equal share in the property. Municipal value, fair rent, standard rent, rent received 15,000 per month. The loan for the construction of this property is jointly taken and the interest charged by the bank is 25,000, out of which 21,000 has been paid. So interest is allowed on accrual basis. You have to keep this in mind. So the answer to the question should be 25,000 and it will be apportioned based on the equal share. Interest on the unpaid interest is 450. Mind you, interest on the unpaid interest is not allowed as a deduction. To repay this loan, Mr. A and his brother have taken a fresh loan and interest charge on this loan is 5,000. So for fresh loan taken will be allowed as a deduction. Fresh loan taken, the interest paid on the fresh loan to repay the previous loan is allowed as deduction. So 5,000 will be allowed and municipal taxes of 5,100 have been paid by the tenant. So here the amount is paid by the tenant. Municipal taxes should be paid by the owner. It's allowed on paid basis. However, the same should be paid by the owner. Here, since it is paid by the tenant, it won't be allowed as a deduction. So two things over here. Unpaid interest is not allowed as deduction and municipal taxes paid will be not allowed to the owner since it is paid by the tenant. Compute the income from this property chargeable in the hands of Mr. A for the assessment year 2021. So we will have to compute the income from the house property. In the note section, let's solve the problem as we would have solved in the examination. Computation of income from house property. It will be always better that you should have some note or a book to note this down and you should start solving along with me so that this will help you in practicing the format of income from house property and this will help you how to solve what should be your thought process. But again, start. What should be your thought process that will help you in the examination? Computation of income from house property of Mr. A for assessment year 2021. This is bold. Then particulars and in another column it will be amount. For simplicity purpose you can draw two columns of amount as well. In the extreme right hand column that will be the final amount, final answer, and in the amount nearby to the extreme right you can place the working amount in the amount section. So for the time being in this answer I am doing only one column of amount over here. So particulars first would be the gross annual value. You can mention this step over here that will help you out. Step 1 is nothing but determination of gross annual value. It will be the expected rent Diminution of expected rent. Expected rent is nothing but municipal value or fair rent, whichever is higher, but restricted to standard rent. So the answer would be 1,60,000, 1,50,000. 1,60,000 is the higher amount and restricted to standard rent. Standard rent itself is higher, so 1,60,000 will be the answer as expected rent. Expected rent is nothing but in the amount column we will mention it as 1,60,000. Step 2, actual received receivable. It will be nothing but 15,000 into 12 was the house property not let out for few months. No, there is no info as such. Accordingly, and at 51 lakh, let's use the KC only. 1,50,000 into 12, 1,80,000. 1,80,000 is the amount actual rent received or receivable. Step 3 is nothing but determination of gross annual value, which is nothing but higher of expected rent, higher of expected rent or actual rent. We have the answer as 1,80,000 gross annual value less municipal taxes. The same will not be allowed, not allowed as deduction, as the same is paid by the owner, is paid by the tenant, so it is nil. Net annual value, which is the NAV, is nothing but 1,80,000 itself, then less standard deduction will be available under section 24A. It is 30% of net annual value 54,000. This amount 54,000 can be mentioned in the inner column of the amount less interest under section 24B. This will be, first is 25,000. So first notes you can mention as interest of rupees 25,000 will be allowed as deduction on accrual basis. So it is not on paid basis, but it is on accrual basis. Municipal taxes are on paid basis, paid by the owner, and interest is always on accrual basis. Interest on unpaid interest is not allowed as deduction. And the next part of interest is interest on fresh loan taken to repay the original loan is allowed as deduction. So 5,000 plus 25,000, 30,000 will be the amount which is allowed as deduction over here. So the interest amount ideally is 30,000. So 54,000 minus 30,000 is will be deducted from 1,80,000. So 96,000 is the amount. Income from house property is nothing but 96,000, and the property was co-owned. So as per section 26, property will be apportioned based on the share in the property. If the share is readily ascertainable, in those cases, the income from house property will be apportioned based on the share percentage. So in this case, equal share meaning 50% of the income will be taxable in the hands of Mr. A. So income from house property apportion in the hands of Mr. A as per section 26, co-owner is equal to 96,000 divided by 2, which is equal to 48,000. So this is the end of the solution. Now moving on to the next solution, next illustration. Mr. X owns a Mr. X owns one residential house in Mumbai. The house is having two identical units. First unit of the house is self-occupied and the another unit is rented for 8,000 per month. So there are identical units over here, and first is self-occupied, second is rented for 8,000 per month. The rented unit was vacant for 2 months during the year. The particulars of the house for the previous year 1920 are as under: standard rent, municipal valuation, fair rent, municipal taxes paid by Mr. X, in this case paid by the owner, 15% of municipal valuation, light and water charges, interest on borrowed capital, lease money, insurance charges, and repairs. There are miscellaneous expenses which have been noted down over here. However, the SSC gets a standard deduction under section 24A, and the miscellaneous expenses which are actually incurred by the SSC are not allowed. He gets a standard deduction of 30% under section 24A, and another deduction which is allowed is the interest on the loan which is borrowed on the house property, which is allowed under section 24B. So what we are supposed to do is compute income from house property of Mr. X for assessment year 2021. Here lease money, insurance, and repairs. Repairs also, if you see, there is no loan on repairs. There is no interest paid on repairs. So ideally this 3 won't be allowed as deduction. This page is not relevant as such. Come back to here. You need to calculate the income from house property. So let's go unit by unit. Again, we will be solving the solution. Computation of income from house property of Mr. A, of Mr. X for the assessment year 2021. Particulars and amount. Next is computation. Let's go step by step. Step 1, determination of expected rent. Again, you will have to mention that the note hire of municipal value or fair rent, but restricted to standard rent. So answer in this case will be ER is equal to 1,90,000. Higher of 1,90,000 and 1,85,000 is 1,90,000 and restricted to 1,62,000. So accordingly, the amount should be 1,62,000. Expected rent. Also, we have to mention which unit we are taking. So unit 1 let out property. So we will have to apportion since it's an identical unit. So apportion ER is nothing but 1,62,000 divided by 5 divided by 2, which is nothing but 81,000. Step 2, determination of actual rent. In this case, the property was vacant for 2 months, and for the rest of the months, 8,000 into 2, 8,000 into 10 is nothing but 80,000. If the property wouldn't have been vacant, then ideally the actual rent would have been for 12 months for 96,000. So if we compare it with expected rent is 81,000 and the actual rent is 80,000 instead of 96,000 if it would have been 12 months. So step 3 should be determination of gross annual value. So determination of gross annual value is as per section 26(1)(c), lower of actual rent and expected rent, or you can tweak it, actual rent will be the gross annual value of the property where actual rent is lower than expected rent on account of vacancy. So the note says as per section 26(1)(c), the actual rent will be the gross annual value of the property where actual rent is lower than expected rent on account of vacancy. So determination of gross annual value is nothing but 80,000 and 81,000. So lower of the two, 80,000 is the gross annual value. So let me mention it over here. Gross annual value is 80,000 plus municipal taxes allowed on paid basis by the owner, 15% of municipal valuation, 1,90,000 into 15%, 1,90,000 into 15%, 28,500, 28,500. Again, it should be apportioned. So the amount should be 14,250. Net annual value is nothing but 65,750 less 30% deduction under section 24A. Cut. Start. So into 30%, 19,725. 19,725 is the standard deduction less interest, deduction of interest under section 24B is equal to interest on borrowed capital is 1,500 per month, with which should be into 12 and divided by 2. 1,500 into 12 divided by 2 is nothing but, so we will have to mention it over here, 12 months and divide by 2. So it is nothing but 9,000. Income from unit 1 is nothing but have we apportioned? Yes, we have apportioned. So 65,750, sorry, 65,750 minus 19,725 minus 9,000, 37,025. 37,025 and unit 2, which is the self-occupied property. In this, the annual value is obviously nil less deduction of interest deduction of interest under section 24B is 9,000. It was apportioned earlier over here. This was the amount. This is 50%. So next 50% over here. So you can say income from unit 2, or rather say loss. Loss from unit 2 is nothing but 9,000 mentioned in the final column. So income from house property is nothing but 37,025 minus 9,000, 28,025. 28,025 is the income from house property taxable in the hands of Mr. X in the assessment year 2021. So moving on to the next illustration. Mr. A owns a house property whose municipal value, fair rent and standard rent are 96, 1,26,000 and 1,08,000 respectively during the financial year 1920. One third of the portion of the house was let out for residential purpose at a monthly rent of 5,000. So one third portion has been let out for 5,000. Remaining two-third portion was self-occupied by him. Municipal tax at 11% of the municipal value was paid during the year. The construction of the house began in June 2012 and was completed on 2015. May 2015, Mr. A took loan of 1 lakh on 1st July 2012, that is after construction of house. The loan was taken on 1st July 2012 for the construction of the building. Okay, the house construction of the house began in June 2012. Okay, fine. So the loan was taken thereafter for the purpose of construction of the building, and the construction was completed in May 2015. So there is an element of pre-construction interest over here, which will be from July 2012 till March 2015. So financial years covered are 12, 13, 13, 14, 14, 15. For these 3 years, interest paid will be pre-construction interest, and it will be allowed in 5 equal annual installments from the year of completion, from the financial year of completion of the construction. So 31st May 2015, so 15-16 is the first year, 15-16, 16-17, 17-18, 18-19, and 19-20 is the last year, is the fifth year in which the pre-construction interest will be allowed. So in a way it is affecting the computation. So there is a pre-construction interest over here. Now continuing, he paid interest on loan at 12% per annum, and every month such interest was paid. So it was a monthly interest, and accordingly the interest will have to be calculated from July 2012 to March 2015. What is expected is compute income from house property for the assessment year 2021. Where to keep the cursor, where to keep the notes? Fine, I'll keep it over here. So there is no co-ownership as such, but there is division of the house property of 1/3 for let out and 2/3 for self-occupied property. So there are 2 units. So computation of income from house property for assessment year 2021, and particulars an amount. So we have gross annual value. So let's go step by step. Rather, let's go unit by unit. Income from unit 1. Unit 1 is SOP, for example. So 2/3 of the portion. So it will be important for calculation of the interest amount. Annual value will be obviously nil, less interest under section 24B. So there will be two type of interest over here. Everything is coming in bold. So I have unbolded. Annual value and okay, pre-construction interest would be calculated. So from July 2012 to March 2015, so how many months we are talking about is for 2012-13, it should be April, May, June, so 9 months plus 12 plus 12, so 33 months we are talking about. Fine, and 12% per annum interest was paid for each and every month. 1% interest should be for every month. and the amount of pre-construction interest amount, how much it should be. Okay, that's what we have to calculate it over here. And the loan amount, I'm talking about the loan amount is 1 lakh. Okay, so loan amount pre-construction interest, need to go over here. 1 lakh into 33% ideally. So it should be 33% and 1/3 portion. It should be a portion to divide by 3. So this pre-construction interest is 33% fine, and it should be divided by 5 because 5 equal annual installments, and then to make it least complicated we will apportion it. So 33,000 ideally divided with 5 divided by 5, 6,600, 6,600, 6,600 will be apportioned based on 1/3 of the portion of the house property was let out. So this is a self-occupied property, so ideally it should be 2/3, so into 2, so it should be 66. So 4,400 is the amount of pre-construction interest which should be mentioned over here. And the interest amount during the year, I feel the loan is not repaid yet. Construction, it took a loan for construction of house property. The construction was completed. Paid during, okay, 12%. So 12,000 will ideally be available still. So interest during the year. Interest during the year is nothing but 12,000, which is 12% of 1 lakh, and it should be apportioned divided by 3 into 2 is equal to 2,000 into 2, which is 8,000. Total interest we mentioned in the outlook column is nothing but 12,400, which is nothing but pre-construction interest of 4,400 and interest paid during the year of 8,000. So 12,400 is the amount. 12,400 is the amount. 12,400, and okay, so it's SOP property, then we need not mind. So loss from the from unit 1, you can say from unit 1 is 12,400. Then let's go to income from unit 2, which is LOP property, and which is 1/3. Everything will be 1/3. Here first step is to compute municipal value. Step 1, determination of ER, which is nothing but you have the information of everything. You will have to mention market value, municipal value, or fair rent. Higher of municipal value of fair rent and but restricted to standard rent. So expected rent will be 1,26,000 higher of municipal value and fair rent and restricted to standard rent. So 1,08,000 is the amount. 1,08,000. There is no vacancy, right? Is there any vacancy over here? Construction, paid interest, compute income. No, there is no vacancy as such. So there is nothing to affect for the actual rent. Actual rent will be monthly rent is 5,000 per month. Step 2, Actual rent determination. Determination of actual rent is nothing but 5,000 into 12, which is 60,000. Am I correct? Yes, it is 60,000. And step 3 will be determination of GAV. So here, ideally, the comparison, if you see, 60,000 is the actual rent and expected rent is 1,08,000. There is no comparison as such. So here we are missing a point, I feel, which is apportionment. Apportioned AR is nothing but 1,08,000, one third divided by 3. It is nothing but 1,08,000. It should be 36,000. So 36,000 is the amount, or you can mention it over here that 36,000 is the expected rent, and still we need to compare with this with actual rent. It's somewhere down the line, it's not matching, but fine. 60,000 and 36,000, whichever is higher, will be taken as GAV. So higher of actual rent or expected rent is the GAV, which in this case will be taken as 60,000. And step 4 is fine. We have GAV now. So 60,000 less municipal taxes paid, if any. Yes, 11% of the municipal value paid during the year. So municipal taxes, which is municipal value is 96,000. 96,000 into 11%. We have done over here. Again, 96,000 into 11%. 10,560. 10,560. Okay, over here I need to mention. So 10,560, which also should be a portion. So divide by 3. 3520. 3520. Net annual value is nothing but net annual value. Okay, fine. Negative sign. So net annual value is nothing but minus 60,000. 56,480. Now standard rent. So not a standard rent. You will need to mention that less 30% standard deduction under section 24A. That is nothing but into 30%, 16944. 6944, and less interest amount. Interest, reduction of interest, reduction of interest under section 24B, which should be same as self-occupied property, only one third of the portion. So why did we do over here 4,400? So ideally reconstruction interest 6,600. For reconstruction interest 4,400. Okay, 4,400, which is after apportionment of two-third. So ideally 6,600 should be one third. and interest paid during the year is 12,000. 6,600 plus 12,000. 6,600 plus 12,000 divided by, this is the one third portion, 6,600 plus 12,000 divided by third. 6,200 is the interest amount in negative. So over here, income from unit 2, we can say 56,480 minus 16944 minus 6,200, 33336, 33336, and total income from house property, we can say 33336 should be adjusted for 12,500, 2936. 2936 over here is the answer, which will be taxable in their hands, which will be taxable in the hands of Mr. A for assessment year 2021. Just to make sure that we are not missing any point. So first is covered first para, second para, one third of the portion fine, 5,000 per month rent fine, remaining two-third portion was self-occupied by him fine, then municipal tax at the rate 11% of municipal value that has been accounted for, then construction interest is the pre-construction interest that we have calculated. Okay, so we are all good. So the interest amount, income from house property, is 2936, which will be taxable in the hands of Mr. A for assessment year 2021. Now moving on to the next solution. Miss Mrs. R, a citizen of USA, is resident and ordinarily resident in India during the financial year 1920. So she is ROR and her global income will be subject to tax in India. She is a citizen of USA as well. She owns a house property at Los Angeles, USA, which is used as her residence, which is a self-occupied property. The annual value of the house is $20,000. Here, the annual value won't be relevant because the same is used for residence and the annual value will be nil. The value of one USD dollar may be taken as 65. She took ownership. She took ownership and possession of a flat in Mumbai on 1st July 2019, which is used for self-occupation while she is in India. So this property as well is used for SOP, and as per the law, you can use two house property as self-occupied property. Continuing, the flat was used by her for 7 months only during the year ended 31st March 2020. The use of the asset, the use of the property in a way is not relevant because the property was self-occupied or unoccupied for the entire year. Continuing, the municipal valuation is 32,000 per month and fair rent is 4,20,000 per annum. Municipal value and fair rent won't be relevant in this case because the self-occupied property annual value will be nil. She paid the following to Corporation of Mumbai. Again, this will be not relevant because the municipal taxes deduction is not allowed for a self-occupied property. She had taken a loan from a bank in June 2017 for purchasing this flat. For purchasing the flat in India, the loan was taken in June 2017 and she got the possession or she got the ownership of the flat only in 1920, July 2019. So the financial year 1920. So there could be an element of pre-construction interest over here. Interest on loan are as under period prior to 1st of April 2019. Yes, so this is the pre-construction interest which will be allowed in annual equal installments starting from 1920. So 49,200 divided by 5 will be the interest, pre-construction interest allowed in financial year 1920, period from April to June 2019. This will be considered as paid during the year. This won't be termed as pre-construction interest, because pre-construction interest paid only till 31st of March 2019 will be considered, and that is 49,200 as a pre-construction interest. This amount 50,800 paid from April to June 2019 will be available 100% deduction under the financial year 1920. So 50,800 plus 131 1,31,300 is the interest paid during the year, and accordingly the interest amount will be allowed as deduction over here in financial year 1920. Only thing that remains to be seen is whether the overall interest amount should not be more than 2 lakhs. The ceiling limit of 2 lakh will be applicable for the SOP property. Remember, both the properties are either self-occupied property or unoccupied property. Accordingly, the interest will have a ceiling limit of 2 lakhs. She had a house property in Delhi. Okay, so this is the third property which was sold in March 2016. But again, start, which was sold in March 2016. Fine, so it is already sold. In respect of this house, she received arrears of rent. So there are arrears of rent which is received of 60,000 in March 2020. So it will be taxable in the year of receipt, and 30% standard deduction will also be eligible. Even if the SSA is not the owner, the same will be subject to tax in the year of receipt. This amount has not been charged to tax earlier, so it will be taxed in the financial year. If it would have been charged previously, then it won't have been charged in this year, only because to avoid the double taxation. So if we charge it again in 1920, there are chances of there will be double taxation, which is not allowed as per law. Compute the income chargeable from the house property of Mrs. R for the assessment year 2021. So in this page, the relevant field is 60,000 arrears of rent needs to be taken for the third property, which currently she is not owning, and we need to compute income chargeable under the head house property. In this page, the relevant information is not so. So we will continue from here. Of income from house property. Computation of income from house property. First is property 1. Property 1 is the USA property. This is a self-occupied property, and accordingly annual value will be nil less interest amount, deduction of interest under section 24B, which should be, there is no deduction as such for this property then. So NAV is, or income from property 1 is nil. And property 2, it is the Mumbai flat. Annual value again will be nil because it is self-occupied property. Less deduction under section 24B, which will be reconstruction interest, which is 49,200 divided by 5 equal to 49,200 divided by 5, 9840 is the amount, and interest paid during the year is nothing but 50,800 plus 131,300. So 182, 100, 182, 100. The total amount will be plus 9840. So it is within the ceiling limit over here. Total interest is nothing but 191,940, and so the loss from property 2 is nothing but 191,940. So now property 3 is nothing but property was at Delhi property 60,000 is the arrears of rent. It's not saved over here. The working has just vanished. Fine. So property 3. Property 3 is nothing but 60,000 arrears of rent, which will be taxable as per section 25A in the year of receipt. In the year of receipt, irrespective whether the SSC is the owner or not in the relevant financial year. If he is not the owner in this year, then also it will be subject to tax in this financial year. Less, there is no interest amount on this property. However, there is a standard deduction which will be available, 30% of NAV. So 60,000 into 30%, it's nothing but 191. First, let me mention it over here. Property 2, 191,940 before deleting it, and 60,000 into 30% is nothing but 18,000, and it should be deducted. So 42,000 is the income from property 2. Property 3, 42,000. Total income from house property is nothing but 191,940. So you can say 42,000 minus 1 lakh, 1,19,940. 191,940 minus 42,000. 149,940. 149,940 is the loss from house property which the SSA will be eligible, in which two brothers A and B are co-owners of house property with equal share. So they are co-owners with equal share. The property was constructed during the financial year 1998-1999. The property consists of 8 identical units. So there are 8 identical units and is situated at Kerala. Fine. In the financial year 1920, each co-owner, which is A and B, occupied one unit. So 2 units were occupied for residents, and the balance of 6 units out of 8 were let out at a rent of 12,000 per month per unit. Reading this again. During the financial year 1920, each co-owner A and B occupied one unit for residents, and the balance of 6 units were let out at a rent of 12,000 per month per unit. Municipal value of the property is 9 lakhs, and the municipal taxes are 20% of municipal value which were paid during the year. So on paid basis, the municipal taxes will be allowed on the let out property. The other expenses were as follows: repairs and insurance premium paid. The same won't be allowed for the purpose of computing the income from house property because the SSC is eligible for 30% standard deduction. You can mention this in the note section. Interest payable on loan taken for construction of the house is 3 lakhs. Mind you, the date is yet not mentioned over here when the loan was taken. If the loan is taken before 1st of April 99, then the interest amount will be restricted to 30,000. That's what you need to keep in mind, because the construction of the property was in 1998. So effectively, it may be possible that loan is also taken before 1st of April 1999, and accordingly, the interest deduction will be restricted to 30,000 for self-occupied property. One of the let out units remained vacant for 4 months during the year. So one of the let out property was vacant for 4 months. So vacant, let me highlight it. A could not occupy his unit. Just to add on over here, let's take a pause. The things which I am highlighting, probably in the examination, what you can do is just highlight in the exam paper. In the examination, just highlight in the question paper the important points, because your way of reading should be like you are reading the entire question once, and you are already interpreting things the way I am interpreting. So in the mind, you should be interpreting things at what should be the solution, and then when you have already tick marked certain points are highlighted, that will help you out in the second reading of the question. And the second reading of the question is always important, so that you don't miss any relevant point which will be useful while calculating the solution. So continuing, A could not occupy his unit, which is one of the co-owner, his unit for 6 months, as he was transferred to Chennai. He does not own any other house. So a self-occupied property and an unoccupied property, then also the annual value will remain to be same. So the nature of the house property doesn't change from this sentence, because part of the month the unit was self-occupied and part of the month the unit is unoccupied. So in this sense, since the property is either self-occupied or unoccupied, the property's annual value will remain nil. The other income, so this probably you can mention it in the note section. The other income of A and B are 2,90,000 and 1,80,000 respectively for the financial year 1920. The nature of the income is not mentioned over here. Of other income, compute the income under the head income from house property and the total income of two brothers. So we need to compute the income under the head income from house property and the total income of two brothers. So on this page, the relevant information is one of the unit was vacant and the construction interest is 3 lakhs. So that's what we have highlighted over here. Okay, so the note section. Two brothers A and B are co-owners. So co-owners. So there are units over here in which 8 identical units. So out of 8, 6 units are let out and 2 units is self-occupied. So 2 divided by 8 is nothing but 25% we can say. So SOP is 25% and LOP is 75%, and we need to determine the total income of A and B in this case. So let's go property by property. First we will compute SOP property, income from our SOP property or loss from SOP property, then income or loss from LOP property, then we will apportion it, and later on the total income will be computed by adding the other income section. The first part is computation of house property, computation of income from house property, property of A and B for assessment year 2021, particulars and amount. So income from SOP is nothing but annual value will be nil less interest. Interest we will have to put a note over here for the construction part because there is absence of information over here. So deduction of interest under section 24B, there shouldn't be any pre-construction interest as such. Is there any information on pre-construction interest? Interest payable on loan taken for construction of house is 3 lakhs. This is what is mentioned over here. So what we will have to do is we have to put a note over here. Deduction of interest, assuming that construction loan on the construction of the property was taken in financial year 1998-99. Interest deduction will be restricted to 30,000. So we have assumed a certain portion saying that since the construction started in 1998, we have assumed that even the loan, in absence of information, we have assumed that even the loan was taken in the same financial year. So in absence of information, you can always mention it. In absence of information, we have assumed we have assumed that loan on the construction of the property was taken in financial year 1998-99. Interest deduction will be restricted. Accordingly, interest deduction will be restricted to 30,000 for both of them. So for A and B, loss from SOP property is 30,000 each. Now property 2, or rather, and have we should we apportion the amount or not? Because there is an apportionment of 25% which is coming up over here. Okay, the question of apportionment won't be affected because in a way this 3 lakh will be first apportioned to 25%, and 3 lakh into 25% is the amount ideally that should be available. So 3 lakh into 25%, 75,000 is the amount, and 75,000 would anyways will be restricted to 30,000 each. So ideally the way to put it over here is 1,50,000 should be apportioned for 25%, and that will be allowed as deduction. 75,000 divided by 2, which is 37,500, which is each portion, and the same is restricted to 30,000. Accordingly, we have rightly calculated the 30,000 amount each over here. So moving on to let out property, which is property 2, let out property. This should be 75%. In this case, there are 6 units and the rental income is this. So step 1 is ER. ER is nothing but we have information only on municipal value. So no fair rent and no standard rent. So ER will be 9 lakhs, and the same needs to be apportioned to 75%, which is equal to 6,75,000 for 6 units. The apportionment of the co-ownership, we will do it once we calculate the total income from LOP property. Step 2 is actual rent, in which case 12,000 per month per unit is the amount. 12,000 per month and per unit. However, there is a vacancy over here. Vacancy over here is 1 unit only for 4 months. 1 unit only for 4 months. So 12,000 for 4 months into 1 unit is equal to, we will have to calculate this, 12,000 into 12 into 6, 8,000, 8,64,000, and 12,000 into 4 is nothing but 48,000. 8,16,000 is the amount of actual rent. This will be compared with 6,75,000, so actual rent is the higher. So step 3 is nothing but GAV, but on account of vacancy, that doesn't matter. The actual rent is anyways higher, so we will continue to consider the practice where GAV is nothing but higher of expected rent or actual rent. Actual rent is the higher. 8,16,000 is the GAV. Next step is less municipal taxes, which should be 20% of municipal value, which is 9 lakh 20%. So it should be 90,000. 1 lakh 80,000 should be the amount. 9 lakh into 20%, and it should be 75% of it. So the amount is, so let's do this first. 20% is fine, and into 75%. 1 lakh 35,000 is the amount. 1 lakh 35,000 is the amount which should be in brackets, and the NAV accordingly will be 816 681 681,000 less 30% standard deduction, which is nothing but into 30%, 204,300, 204,300, and less interest amount. Interest under section 24B you need to mention, which should be, we have calculated it over here, which was 1,50,000 into 75% should be the case, and we will apportion it at a later point of time. So 1,50,000, 3 lakh was the amount, right? 3 lakh is the interest amount. Okay, 1,50,000 over here was apportioned based on the share of the co-owners. That's why it was 1,50,000. We will continue to mention it over here as 3 lakh into 75%, right? So 3 lakhs into 75%, 225, 2 lakh 25 is the amount. So we have the interest amount as 2,25,000. So income from LOP property, income from LOP is nothing but 681,000 minus 204,300 minus 225. So 251,700 is the amount. 251,700 is the taxable amount. So apportion it, right? We need to apportion it based on the co-ownership. The let out property is co-owned, so 50% share is nothing but divided by 2. 125,850, 125,850. So this is the individual share of A and B from LOP property, and from SOP property the individual share was 30,000 each. So total income of A will be 30,000 minus plus 125,850. And what is the income of Mr. A? 2,90,000 of A and 1,80,000 of B, plus 2,90,000. Total income is plus 2,90,000 minus 30,000. 385,850. 385,850. This is income of Mr. A, and total income of B is nothing but 30,000 plus 125,850 plus 1,80,000. So ideally I have to minus this 2,90,000 and plus 1,80,000. 275,850. 275,850. So the total income of Mr. A is 3,85,850 and total income of Mr. B is 275,850. Just to make sure that we haven't missed any point, so first para is fine. Equal annual installments. Equal installments of the co-owners has been bifurcated. The property was constructed in 1998. That is fine. Consists of 8 identical units. That is also considered co-owner occupied 1 unit of residence and balance of 6 units were let out at a rent. There is a fine municipal valuation. That's what we have done. Okay, you will have to mention a note for repairs and insurance premium where 30% standard reduction is available. The expenses on repairs and insurance premium won't be available. Interest payable, we have assumed that the loan was taken in 1998. Accordingly, the note is already put over there. One of the let out units remain vacant. Vacant is already taken care. For this point also, you can mention a note wherein this information is not relevant in this case because the property is occupied by Mr. A. The property is self-occupied or unoccupied. Accordingly, the treatment, the benefit of exemption, the benefit of nil value of SOP will be available to Mr. A. The other income we have already taken care. Compute the income under the head income from house property, which is computed the total income of two brothers for the assessment year 2021. So this concludes the illustration part. After illustrations, the concluding topic for income from house property is the MCQ. In MCQ, you will get 4 options to solve the question. In this, relatively, you will observe that the these questions are not so challenging, but the only thing is how to navigate through the options, and in the examination how you should interpret a question, and the various options given, how you can eliminate and derive the correct option. So this is what will be important, and there will be a series of question paper as well at a later point of time, in which the level of the MCQ will be at a difficult level for a final CA student level. So for the time being, for this MCQ, this is a practice level MCQ for your revision purpose, and so that you get used to the MCQ part, because as it is, you will have questions in the examination related to MCQ. So chapter wise MCQ bifurcation is very much important. Chapter wise MCQ practice is very much important. So illustration MCQ, vacant site lease rent is. Vacant site lease rent. Vacant site lease rent, in a way, in income from house property, we have studied that rent from a vacant land is taxable under income from other sources. The same won't be taxable as income from house property. So how it is taxable? Option A, income from house property, no. Business income or income from house property as the case may be, no, it is not taxable as income from house property. C, income from other sources or business income as the case may be, yes. Income from other sources, yes. And business income may be dependent on the nature of services provided by the SSC. Option D, income from other sources or income from house property as the case may be. As I told that, vacant site lease rent is never taxable in income from house property. So option C is the correct answer. Now the second part, deduction under section 24A. Deduction under section 24A. Repeatedly we have mentioned in the illustration that it should be 30% NAV. We will go option by option so that how to eliminate in examination is important. Option A, 1/3 of NAV, no. B, repairs actually incurred by the owner. Repairs actually incurred by the owner, expenses incurred by the owner are not allowed as deduction. There is a 30% standard deduction available to the SSC. So not even option B. Related to repairs, the SSC can get interest on repairs, but that will be in 24B, and that too for SOP property it is restricted to 30,000. So option C, 30% NAV, yes. Interest on borrowed capital, option D, no, it is allowed in 24B. So the correct option over here is 30% of NAV. Question third, interest on borrowed capital accrued up to the end of the previous year prior to the completion of. Again, interest on borrowed capital accrued up to the end of the previous year prior to the year of completion. So this could be pre-construction interest prior to completion of the construction, is option A, allowed as a deduction in the year of completion of construction. Yes, it is allowed, but it is allowed in 5 equal annual installments. So it is not allowed as 100% deduction. It is allowed in 5 equal annual installments over a period of 5 years after from the year of completion of construction. So option B, allowed in 5 equal annual installments from the year of completion of construction, yes. Option C, allowed in the respective year in which the interest accrues. Allowed in the respective year in which the interest accrues, no, it is not allowed prior to the completion of construction. It is only allowed from the year in which construction is completed, construction or acquisition is completed, and thereafter it will be allowed for 4 more years. Option D, not allowed. No, it is allowed, and option B is the answer. Now fourth illustration, the ceiling limit of deduction under section 24B in respect of the interest on loan taken on for repairs of self-occupied property is, again, the ceiling limit of deduction under section 24B in respect of interest on loan taken on 1/4/2019 for repairs of self-occupied property is 30,000 per annum, yes. 1,50,000 per annum, no, there is no such limit. 2 lakh per annum, this ceiling limit is applicable for acquisition of the property, acquisition or construction of the property, and also loan taken prior to 1/4/1999, the ceiling limit applicable 30,000 is for repairs as well as for acquisition of the property, and post 1st of April 1999, this ceiling limit is not applicable for acquisition of the property or construction of the property. However, loan taken for repairs, the interest amount thereon is always cannot be less than cannot be more than 30,000. There is a ceiling limit for repairs of 30,000 for self-occupied property. So, and option D is no limit. This limit, if it would have been a let out property, then this limit would have been applicable. So in this you can see the options given somewhere down the line is more or less applicable, but for different scenarios. For this scenario, option A is the answer. Moving on to the next question. A received 90,000 in May 2019 towards recovery of unrealized rent. So in the previous year, the amount has been received as unrealized rent, which was deducted from actual rent during the previous year for determining the annual value. So in the previous year 1718 it wasn't subject to tax. Legal expense incurred in relation to unrealized rent is 20,000. So there are expenses incurred by the SSC for unrealized rent. Unrealized rent is been realized in the current financial year. It wasn't subject to tax earlier, so it will be taxable in the year of receipt as per section 25A, irrespective whether the SSC is the owner or not. And for the expenses part, the SSC is allowed 30% of NAV, and the 20,000 portion, legal expenses incurred of 20,000 won't be allowed. For that, 30% of NAV straightforward is allowed to the SSC. So the amount taxable under section 25A would be 70,000, which is 90,000 minus 20,000 of legal expenses. No. 63,000. 63,000 is nothing but 90,000 into reduction of 30% of NAV. So this is the answer. Exploring other options. 60,000. 60,000 is not applicable in this case, and 49,000 will be something 90,000 minus 70,000, and thereafter on the remaining amount, on the net amount, 30% has been deducted. However, legal expenses deduction is not allowed to the SSC because he is getting 30% deduction straightforward. So in this case, answer is B, 63,000. Now the last question. G and R are co-owners of self-occupied property. They own 50% share each. The interest paid by each co-owner during the previous year on loan taken for acquisition of property during the year 2004 is 2,05,000. The amount of allowable deduction in respect of each co-owner is, again, G and R are co-owners of a self-occupied property. They own 50% share each. The interest paid by each co-owner during the previous year on loan, the loan was taken for acquisition of property, is 2,05,000. The amount of allowable deduction in respect of each co-owner is, it is 2 lakh for each of the co-owner. So not 2,05,000. There is a ceiling limit applicable for self-occupied property. Not 1,02,500. 1,02,500 is nothing but 2,05,000 divided by 2. But the limit or the interest deduction is available to each of the co-owners, but it will be subject to the ceiling limit of 2 lakhs. So not option A, not option B. Option C, 2 lakhs, yes. Option D, 1 lakh, no. 1 lakh is 2 lakh divided by 2. in which the first ceiling limit is made applicable and then it is made divided by 2. So the correct option over here is 2 lakhs. So friends, this concludes the MCQ part, and with this we have completed all the topics in the main topic of income from house property. Thank you.